Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review, a tech bloodbath rocks Wall Street as Nasdaq plunges over 2%, good news turns toxic as strong data, and stellar earnings trigger a market paradox, sparking a massive rotation out of growth. Is this the correction storm we've been waiting for? Second, alert. Official jobs data masks a white-collar recession. College-educated workers face unprecedented threat. The government reports strong job growth, but layoffs are hitting record highs, and a shocking group is bearing the brunt. What is the hidden truth in the data, and is the Fed flying blind into a crisis? Finally, crisis looms. Freight market plummets. Imports collapse 33%, signaling a structural goods recession. Retailers are betting on the weakest holiday season in years, with one CEO warning of a major reset for the entire economy. Is this the canary in the coal mine signaling a broader collapse is imminent? Alert, today's market is a battlefield, and the stakes couldn't be higher. Listen to me, the Nasdaq just took a nosedive, dropping 2.2%, and the S&P 500 wasn't far behind, shedding 1.6%. This is a clear signal the tech-heavy Nasdaq is in retreat, and we need to act decisively. The reason for this turmoil? It's a perfect storm of mixed economic signals. First, stronger than expected employment data has thrown cold water on hopes for a December rate cut. Meanwhile, Nvidia's stellar earnings couldn't save it from a sell-off, as doubts about the sustainability of AI capital expenditures loom large. The Federal Reserve's rate cut probability has plummeted from 98.8% to just 30 to 32%, slamming the door on easy money expectations. Let's break it down. We're seeing a significant policy shift. The Fed's data-dependent stance now leans hawkish as employment numbers suggest resilience in labour demand. With unemployment inching up to 4.4%, the Fed has room to keep rates steady despite market hopes for cuts. This isn't just a temporary hiccup, it's a structural change. The Fed's internal divide on rate cuts is more pronounced than ever, with several regional presidents voicing opposition to further reductions. This means the era of higher for longer is here to stay. Money flows are reflecting this shift. Investors are rotating out of high valuation tech stocks and into value plays. The VIX is creeping up, signaling rising fear, and we're seeing capital flight from growth into defensive sectors. With the Nasdaq nearing correction territory, there's a clear rotation underway. Valuation implications are stark. The tech sector, with its inflated P divided by E ratios, is under pressure. Nvidia's paradoxical plunge, despite strong earnings, highlights the market's concern over growth sustainability. High valuation tech stocks are facing multiple compression, and unless inflation data turns favourable, this trend will continue. Now, here's the strategy. Cut your exposure to high valuation tech immediately. I'm telling you, rotate into financials and consumer staples today. Maintain core positions in mega cap tech with strong cash flows like Microsoft and Apple, but trim the high beta names. The 6,400 to 6,550 range on the S&P 500 is critical. If it breaks 6,400, brace for a deeper correction. Sector focus. Consumer staples are shining. Walmart surged 6% on strong earnings, underscoring a flight to quality. Meanwhile, semiconductors are taking a hit. Nvidia, despite its strong numbers, saw its stock weaken. Watch for defensive sector ETFs like XLP and XLU to outperform as investors seek stability. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. In the short term, assuming this rate environment persists, overweight consumer staples like XLP and underweight tech stocks cut QQQ by 15 to 25%. For the medium term, add 3 to 5% to financials like XLF to capitalize on higher net interest margins. If the 10-year yield breaks 4.5%, hedge with utilities like XLU. Advanced traders, consider buying puts on QQQ to hedge downside risk. Intermediate investors, hold 15% cash to deploy on further weakness. Here's the kicker. December 3rd CPI data is your next major trigger. If inflation shows signs of deceleration, it could be a game changer. But if it remains sticky, expect continued pressure on growth stocks. Time's running out. Prepare your portfolio today. Now, let's take a closer look at the specific stories driving today's action. The Federal Reserve is driving in a fog. That's the direct quote from one chief market strategist. and it perfectly captures the chaos roiling the US economy right now. A while back, we called this the Fed flying blind during the shutdown. When the dashboard goes dim, mistakes get easier and consensus gets harder. Now, get this. The Fed makes its decisions based on economic data, but that very data is becoming unreliable. For instance, the Bureau of Labor Statistics recently made a massive downward revision to its past employment data, finding that job growth was actually much weaker than first reported. As we previously analysed, when official releases go dark or get revised, the Fed leans on noisier proxies, raising the odds of a policy error. This means the Fed might be looking at an outdated, overly optimistic map of the economy. If the real trend is weaker than the headline numbers suggest, keeping interest rates high could accidentally push the economy into a recession. That's the fog they're driving in. On the surface, the latest jobs report looks strong. The US added 119,000 jobs, more than double what analysts expected. But that's not the whole picture. The unemployment rate actually ticked UP to 4.4%. And this is where the situation takes a more complex turn. A closer look reveals that previous estimates for July and August were slashed, with August now showing a net loss of 4,000 jobs. Continuing our last discussion, this is that headline positive, revision negative clash we warned would confound policy. Interestingly enough, while the official report showed modest gains, a separate private report found that October job cuts hit the highest level for that month since 2003. We're talking about high-profile companies making drastic moves. Telecom giant Verizon just announced it's cutting over 13,000 jobs, citing changes in technology in the economy. They're not alone. Amazon, Target, and UPS have all announced significant workforce reductions, raising fears that the so-called low-hire, low-fire job market is starting to crack. A while back, we broke down the gap between announced layoffs and actual unemployment claims. The risk now is that these announcements are beginning to bleed into both revisions and the unemployment rate. This might not be a low-fire market cracking, but rather a low-hire market solidifying. The key here is the difference between layoff announcements and the broader job market. While big companies are making headlines with targeted cuts, they are also quietly freezing new hiring. This creates a stagnant job market where dynamism is lost, which is a hidden weakness not fully captured by the headline unemployment numbers. This also helps explain why China's recent manufacturing PMI has been weak. A slowdown in the US goods sector, reflected in these transportation and warehousing job cuts, directly reduces demand for Chinese exports. What really brought this to a head was the next development. The pain is hitting an unexpected group. The unemployment rate for workers with college degrees is rising, jumping from 2.3% to 2.8% in just 1 year. That's exactly where we said the pressure could show up if corporate intent to cut moved into execution. Believe it or not, this figure is often seen as a leading indicator for the health of the entire economy. A rise in unemployment among the highly educated signals a potential white-collar recession. This isn't just about a few sectors. It's driven by broad corporate cost-cutting and possibly the accelerating adoption of AI in professional roles. So the thing is, these higher income workers are the engine of consumer spending. If they start losing jobs or fearing for their jobs, their spending on everything from cars to high-end services could drop, challenging the narrative of a resilient economy. We flagged a while back that consumer sentiment had already plunged. Pair that with rising white-collar joblessness, and the spending outlook gets even shakier. Graduates are reporting they've applied to thousands of jobs, only to be rejected for roles in tech and sales that are then reposted. This all begs the question, what's the real endgame here? Executives at McDonald's and Coca-Cola are warning that their customers are tightening their belts. That lines up with the sentiment slump we discussed a while back. People pull back first, and then the hard data follows. They are describing the potential breaking point of the K-shaped recovery. In this type of recovery, high-income households do very well, their wealth growing from rising asset prices, while low-income households struggle. The warnings from McDonald's and Coca-Cola, which serve a broad customer base, are a lagging indicator that the bottom leg of the K is deteriorating. After all, the broad base of consumption is what truly powers GDP growth. Even if the rich keep spending, a collapse in spending from the majority can still drag down the whole economy. The Fed has already cut rates twice, but Chairman Jerome Powell warns another cut is far from a foregone conclusion. We previously dissected the idea of a hawkish cut as a compromise easing once while signalling a hard stop. Powell's tone echoes that playbook. And remember, we also saw a rare dual direction descent a while back. with some pushing for no cuts and others for bigger ones. With blockbuster job cuts on one side and confusing government data on the other, some of which was delayed or even lost around the shutdown, the central bank is caught between a rock and a hard place, leaving the market, bracing for what comes next. So what should we be watching? The key focal point will be the next set of revisions to employment data. Are the downward revisions continuing? Also, keep an eye on consumer confidence and spending reports, especially those broken down by income level, to see if the K-shaped divergence is worsening. And as we noted before, watch the gap between announced layoffs and actual jobless claims. If that gap closes, the labour market picture could deteriorate quickly. In this environment of uncertainty, if shutdown delayed reports don't materialise, the Fed may lean again on proxies, raising the risk of a misstep. For asset markets, this uncertainty creates cross currents. If the economy is indeed weaker, the Fed might be forced to cut rates sooner, which would be good for bonds. However, a weaker economy means lower corporate profits, which is a headwind for stocks. In this environment of uncertainty, safe haven assets like gold could see continued interest. Speaking of economic uncertainty, another sector is sending out a distress signal that's anything but ambiguous. The US freight market is not in a seasonal dip. According to one industry CEO, this is a structural goods recession. So what does a structural goods recession actually mean? Well, a regular or cyclical recession is like a bad cold for the economy. It's temporary and usually recovers as the business cycle improves. But a structural recession is different. It's a fundamental change in the economy's bones. The real turning point here is that it suggests the downturn in goods demand isn't just about a temporary inventory glut. It's driven by long-term shifts, like changes in global supply chains due to tariffs and a major post-pandemic reversal where consumers are spending less on things and more on experiences. This signals a prolonged period where the prices of goods might actually fall, a concept known as goods disinflation. A while back, we talked about a big box retailer pivoting toward professional contractors and warned that even pro spending is a cyclical leading indicator. Their CFO put it bluntly, at this point, it's hard to identify near-term catalysts that would lead to acceleration. What we're seeing in freight today is that caution migrating from the storefront to the ports and highways. The proof is in the cargo. Data shows furniture imports have collapsed by 33%, and toy imports, which historically surge up to 50% ahead of the holidays, have barely risen 17%. One analyst says this signals that retailers are betting on the weakest consumer season in years. The traditional peak holiday shipping season is now described as virtually non-existent. This points to a split or bifurcated consumer. It's not that spending has collapsed entirely. Instead, there's a significant trade down. While freight for discretionary items like furniture is weak, spending on essential staples and services remains more resilient. This suggests that even as the prices for goods fall, service-related inflation might stay stubbornly high, which creates a complicated picture for the Federal Reserve. As we flagged a while back, the key risk was a spreading deferral mindset. Today's softer discretionary loads suggest that mindset is taking firmer hold. If that was just the appetizer, the main course is just being served. A new forecast predicts a nearly 17% year-over-year decline for US imports this December, with one executive stating, there is no bounce back in sight. This isn't just a forecast. At the nation's second busiest port, the Port of Long Beach, the CEO confirms a 16% decrease in Chinese imports is already happening, calling the decrease across the board. Now, if you zoom out, you'll see another layer of strategy at play here. It's not just about what's being shipped, but where the cargo is and is not coming from. When we place that 16% drop in Chinese imports alongside the fact that US data shows imports from Mexico and Vietnam are actually increasing, the contradiction becomes clear. This suggests that tariffs are accelerating a real and possibly permanent trade diversion. It's not just that demand is weak, it's that the geography of global manufacturing is actively shifting. For Chinese-speaking audiences, this has direct implications, signaling that some export-oriented industries may face long-term pressure as supply chains reconfigure toward other nations. And as we noted a while back, a weaker US consumer can translate into lower demand for imported goods overall, adding pressure to China's export-oriented sectors and potentially its exchange rate. The Long Beach numbers are consistent with that direction. Actually, this isn't a temporary blip. Experts are calling this a major reset of freight demand fundamentals. This is a classic example of the bullwhip effect in the supply chain. During the pandemic, retailers worried about shortages, front-loaded massive orders. Now, facing a consumer who is spending differently, they are aggressively cutting back or destocking. This sharp swing from over-ordering to under-ordering cracks, like a whip up the supply chain, hitting shipping companies the hardest. Container utilization has already dropped from 100% to 91%, and with spot rates at 2-year lows, the industry could be staring down a decade of overcapacity. The cause is a toxic cocktail of tariff uncertainty, a frozen housing market, and a fundamental shift in consumer spending away from physical goods. Continuing our earlier discussion, that housing freeze doesn't just dent furniture demand, it also filters into contractor backlogs and building materials, freight, reinforcing the slowdown we warned could hit the pro channel. The fallout is rippling through the entire supply chain. The projected loss of over 430,000 container units in December alone is creating job anxiety on the docks. As the CEO of the Port of Long Beach put it, labour is absolutely concerned. You know, the freight industry often acts as a canary in the coal mine for the broader blue-collar labour market. A decline in freight volumes is a leading indicator, often signalling future weakness in jobs for logistics, warehousing and trucking. So when you hear about less freight, it could be one of the first clear signs of cracks appearing in what has been a very resilient overall employment picture. Less freight means a reduced need for longshoremen, sending shockwaves from the ports to the railroads and trucking companies that form the backbone of the American economy. So what's next? The key things to watch are the monthly reports on freight volumes and rates, which will tell us if this structural recession is deepening. Also, keep an eye on consumer spending data, specifically the split between goods and services. Continuing our last discussion, add a few broader signals to that dashboard. The monthly existing home sales report and the services spending line in the PCE inflation data. And for stress indicators, the FHA delinquency rate and regional insurance premiums, especially in Florida and Texas. If these deteriorate alongside weak freight, it confirms the slowdown is broadening. This trend could also mean continued downward pressure on the stock prices of logistics and transportation companies, while the bond market watches for signals of a broader economic slowdown.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.